Hello guys, welcome to our third topic for our online classes. We're down to our last types of taxpayers, namely partnerships, estates, and trusts. But first, let's review income tax on partnerships. Generally, we can classify partnerships as taxable or non-taxable. So taxable partnerships are general or commercial partnerships which are also treated as corporations. They're part of the definition of a corporation under the NIRC, and non-taxable partnerships which are GPPs and exempt partnerships or joint ventures. These are those who have service contract with the government for construction projects or energy operations. So again, for general or commercial partnerships, they are taxed like corporations. Therefore, the share of the partners or ventures will be treated as dividends subject to rules on final tax. Also, I'd like to mention that same filing rules for corporations apply to general or commercial partnerships. So use these rules if the recipient of the share is an individual, and use these rules if the recipient is a corporation. So hopefully you have your own summarized tables regardless of the format. But by now you should be able to construct the summaries on your own. And for the net distributable income, it should of course be after the income tax. So here is the pro forma computation for the distributable income. So basically it's just computing for regular income, passive income subject to final tax, and capital gains subject to capital gains tax. Then we apply the appropriate tax rate for each classification, and we add them together. Then we multiply with the profit and loss ratio to determine the share of each partner. From the partner's POV, his share will not form part of his taxable income because again, it shall be treated as dividend subject to final tax. Let's proceed to GPPs and exempt partnerships or joint ventures. Here are the following summarized rules. First, income payments to such are not subject to withholding. This means that customers of exempt partnerships are not to withhold tax from their payment. For filing, they shall still file annual information return even though they're exempt. So it's Form 1702EX, and it's for the purpose of determining the share of the partners. Partners shall be liable personally, and their shares shall form part of their regular income or part of the computation of their net taxable income. Share of partner is taxable whether received or not. So this is where the concept of constructive receipt comes in, and the partner is immediately taxable when his share is credited to his account. The net distributable income should be after creditable withholding tax. So the partnership shall withhold 10% tax if the net distributable income to the partner is not more than 720,000. But if it's more than 720,000, the creditable withholding tax is 15%. Partners can no longer claim additional deductions from their distributive shares in the net income of GPP. So this rule is more relevant when the partner of a GPP uses optional standard deduction. So if OSD yung gamit ni partner, di ba we multiply the gross income by 60% to arrive at the taxable net income. However, hindi natin isasama dito yung share in the income of the partnership kasi in effect, if we do that, nagkaroon pa ng additional 40% deduction on that share. So, if OSD ang gamit ni partner, we multiply the gross income by 60% and then saka natin i-add yung share niya sa partnership. Then that will be the taxable income of the partner. Partners are not allowed to choose the 8% option as we have already discussed in income tax on individuals. And lastly, if lost, this will form part of allowable deductions of a partner. So as you can see here, only the basic or ordinary income will be exempt from income tax. So income subject to final tax or capital gains tax, we will still apply the appropriate rates. and they are not exempt. Here's also the pro forma computation for the distributable income of a GPP. So that's also the same with the previous one, but in here we don't have to tax the net income. From the partner's POV, this will form part of his regular income, subject to regular income tax. So this is not treated as a dividend because, again, the partnership is exempt. Co-ownerships are also worth noting. So this is when two or more heirs inherit an undivided property, or when a donor makes a gift of an undivided property in favor of two or more donors. So the following rules for co-ownership apply. Generally, the co-owners are the ones liable or subject to income tax on their separate capacities. So the co-ownership itself is not a separate taxable entity. However, it will be subjected to income tax as if it's a general partnership if the following situations arise. So first, the co-ownership was formed voluntarily and constitutes that of a business partnership. Second, income of the co-ownership is invested in business or other income-producing properties. And lastly, the property remains undivided for 10 years and no attempt was ever made to divide it. So here's an example for partnerships. X and Y are partners, both resident citizens in the following partnership. So X and Y are both partners in a general partnership and a general professional partnership. And it's also given here their personal income and expenses. We have gross income, deductible expenses, dividends, prices, and royalty. The partners agree to share profits and losses in the ratio 40-60. Determine the taxable income of X and Y in their ITRs. So you can pause this and try to answer it on your own before proceeding with the solution. First things first, let's compute for the net income of each partnership. 200,000 for the GP and 220,000 for the GPP. Since taxable income is what we're looking for, we don't really need to distribute the income from the GP because it will be subjected to final tax, and therefore this is not included in the taxable income to be included in the ITR. But for the GPP, we need to distribute this, so we multiply the 220,000 to 40%, that's 88,000 for X, and 60%, that's 132,000 for Y. The next step is to classify the personal incomes of each partner. So dividends from these are of course subject to 10% final tax. The price of X will be subjected to 20% final tax. However, that's not the case for Y because it did not exceed the 10,000 threshold. So the 8,000 will form part of the regular income. And of course, royalty from books subject to final tax of 10%. Um, in this particular problem, the rates for passive income are not really important since only the taxable income is being asked, but I hope that when you're practicing, try to be as comprehensive as possible by putting notes and rates whenever you can, so you really master them and memorize them. Anyway, going back for X, let's start with the 88,000 plus 400,000 less 250 plus 10,000. The answer for X will be 248,000. That's his taxable income. And for Y, let's start with the 132 plus 280 less 120 plus 8 plus 8. And the answer is 308,000. Okay guys, we're down to our last type of taxpayers, estates and trusts, which are basically tax-like individuals, is what I keep on saying. So this will be a very brief discussion. Here are some common rules that apply to both estates and trusts. Again, they're tax-like individuals, so they're also subject to the 8% option. Deductions from the income earned by estates or trusts include first, income distributed to beneficiaries, and this income distributed to them will form part of their taxable income, except for trust administered in a foreign country, income collected by a guardian of an infant, and note, amount allowed as deduction shall form part of the beneficiary or heir's income, whether this has been actually distributed or not. So if it's already um, counted as a deduction on the part of the estate or trust, then it should automatically be part of the taxable income of the beneficiary or the heir. The income distribution is subject to 15% creditable withholding tax. And here's the very simple pro forma computation for estates and trust. So that's just gross income less allowable deductions, which include expenses and income distributed to heirs. So we arrive at the taxable income, which may be subject to the 8% option or the graduated tax rates. Let's discuss estates. For tax purposes, estates may be judicial or extrajudicial. Estate under judicial administration are taxable as a separate entity, and the fiduciary or trustee files the IDR. On the other hand, estates that are extrajudicially settled, the income of the estate is to be declared by the beneficiaries, and therefore they're the ones to file the IDR. Inclusions in gross income, the same as individual, but emphasis on income received by the estate during the period of administration. During this period, there is no other beneficiary but the estate. Prior to settlement, the executor sells the property for more than the appraised value. So, diba, at the time of death, we compute for the fair market value or the appraised value of the property of the decedent, and then if the executor sells it at a higher price, then the excess will be forming part of the gross income of the estate. Excluded from gross income, passage of property to the executor or administrator on the date of death. So ito yung pinasa lang yung property to the executor or administrator. So there's no actual tax implications. And non-deductible expenses, allowance paid to an heir out of the corpus. So yung income distributed is deductible, but if the term is allowance, this is not deductible. Let's discuss trusts. A trust is a right of property held by one party, called the trustee or fiduciary, for the benefit of another, called the beneficiary. And the one who establishes the trust is called the trustor or grantor. Here are the kinds of trust and the treatment for each. First is the irrevocable or ordinary trust, wherein the property and income does not revert to the grantor. This is taxable as a separate entity, and generally speaking, this is what we're talking about when we speak of trusts. Revocable trusts, this is not taxable as separate entity and will form part of the taxable income of the grantor. Number three is where the beneficiary is the grantor. So, like the second one, this will form part of the taxable income of the grantor. And lastly, employees' trusts. These are exempt from income tax but subject to certain requisites. What's different with trusts is that they may be subject to consolidation when the trustor and beneficiary are the same. So we first consolidate the taxable income, and then we get the total tax due. And then to determine the income tax liability of a certain trust, we just have to get the ratio of its own taxable income over the consolidated taxable income, and then we multiply it to the total tax due. Let's try to apply the concepts of trust and estate. So A created two trusts with separate trustees but a common beneficiary. So we have trust 1, trust 2, and the beneficiary. The gross income, allowable deductions, and income distributed by each trust, gross creditable withholding tax. So the question is determine the taxable income of Trust 1, Trust 2, and the beneficiary. So this is very easy, guys. You can try this on your own before proceeding with the solution. For Trust 1, we simply get the gross income less allowable deduction less income distributed to the beneficiary. It's 450 minus 75 minus 150. That's 225. Diba? Sobrang basic lang. For Trust 2, we do the same thing. It's 1,090,000 less 125 less 175. So the answer is 790. For the beneficiary, we just get the gross income of 250 less 100. Then don't forget to add the income distributed to it by Trust 1 and 2. So that's plus 150 plus 175. And the answer is 475,000. It's very simple, but what might complicate this a bit is if the question is income tax payable. So if in case the question is income tax payable, we get the tax due for Trust 1 and Trust 2 by consolidating them first. That's 225 plus 790 equals 1,015,000. And we have to compute for the tax due using the tax table, then multiply it by 225 over 1,015,000 for Trust 1, 790 over 1,015 for Trust 2. For the beneficiary, we just have to get the tax due from the taxable income of 475 using the graduated tax rates. Then we deduct the 15% creditable withholding tax withheld by the trust to arrive at the income tax payable. So I hope that you noted that down, or you can try it on your own as well. Surprisingly, guys, that's it for income tax on partnerships, estates, and trusts. It's very brief, but problems relating to partnerships can actually be tricky, especially on the part of dividends. So you have to really memorize that. The next video will be a very brief review on gross income and deductions from gross income. I'd also include the installment method in paying taxes. That will be our final review for income tax, after which I'd give a diagnostic test for the whole income taxation topic. So before we proceed with VAT and other lessons. So I hope that you guys learned something new or you've been refreshed. Thank you and stay safe.